Welcome to Real Wealth, Real Health, the show that empowers you with insights, information, and inspiration to achieve your version of financial wellness. Learn how to balance living a full life today with planning for the future. This podcast is brought to you by Alpha Investing, a real estate-centric private capital network that provides exclusive investment opportunities to its members. And now, here are your hosts, Ada Piederico and Daniel Coca.
Hello, welcome to another episode of Real Wealth, Real Health. Our guest today is Vivienne Su. Vivienne is a CFA, an entrepreneur, investment executive, and independent board member with over 20 years of financial services experience. She's worked in institutional finance as a portfolio manager, creating investment products, doing actuarial work, and she is what the industry calls a quant, or she was in her past professional experiences. And Vivienne's career path actually led her to become a social entrepreneur. And today she's the founder and CEO of Lendinate. Lendinate is a unique marketplace lending and donation sourcing platform where nonprofits and supporters leverage their collective power for the greater good. I would call it a form of crowdfunding for investments that support nonprofits. It's a beautiful platform. And in our conversation today, we talk about Vivienne's career path, how Lendinate became the nexus between her quantitative analytical investment background and her passion for philanthropy. There's so much to learn about how nonprofits operate, how they use debt financing, which is a giant $600 billion market, to largely finance real estate of all things, and how Lendinate connects institutional investors and individuals to some very thoroughly underwritten nonprofits on their platform, and so much more. I am sure you're going to enjoy this conversation as much as I had in having it. All right, Vivienne, welcome to the podcast.
Thanks for having me.
Yeah, it's my pleasure. I have been investing in Lendinate, your beautiful company, for a little while now through my IRA. And when I found you and when I found out about Lendinate through How Women Invest and How Women Lead, and we had Julie on a few episodes ago, I was awestruck in a way about how you pulled together this beautiful concept of investing and nonprofits and crowdfunding all in one package. And I really want to dig into that. And before we do, you have a very institutional background in finance and financial services, and you managed, what was it, like several $1 billion of portfolio at one point in your career. Let's just start there a little bit. Like, you started in big institutional finance. What led you to take that career path?
Yeah, well, it wasn't by design. Let me just tell you that. Okay. But I thoroughly loved that job where I ended up, with investment management experience. What led up to it, actually, if we go all the way back, is my math major. I thought after, majoring in math, there are maybe a couple of things I could do, teaching or actuarial science. And I tried the actuary path. And it wasn't quite for me. It was maybe a little too uneventful. So I ended up joining a company in Berkeley that focused on investment analytics. It's called Barra, now acquired by MSCI. So that's where I started my journey with investment analytics, and then I eventually joined American Century Investment, Schwab, and managing the large portfolios that you mentioned. At Schwab specifically, I especially loved the wide range of responsibilities I had instead of just managing portfolios. I actually did get to work across the company with various departments, including product, marketing, and legal and technology. So I'm sure we'll get into, it's a good start for my deciding to take the first step into entrepreneurship.
Okay. Wow. So actuarial science. Oh my goodness.
Not for the faint of heart.
I was going to say, or for the faint of mind. I mean, your ability to is it really calculation based actually? Because like, obviously you have a propensity for math and numbers and that kind of analysis. Like, I'm just going to sidetrack us for a second. I'm curious, like how much is it calculation based? I imagine a lot. Like it must be heavy in the calculations.
It is quite heavy in a very specific way. There are two major branches of actuarial science. One to support insurance companies, and
Yeah.
one to support pension sponsors.
Oh.
So both have the similarity, just different contexts, but both are using probabilistic models to forecast, in one case longevity, in another case, kind of work life, the pension aspect, and the funding requirements for pension plan sponsors, so that they know how much money to put in the plan. If they promise an employee, if you retire in 30 years, you get, some money. So it's very calculation driven, but a lot of that is already pretty standardized. So it's not like each time it's creating out from scratch.
Right. And did you find yourself as one of a few women? Were there a lot of women in that field, or what was that like?
I didn't stay in the field long enough to really network within the field. I know my boss, the person I was working under, she was a woman actuary. So I can see that actually be pretty well suited for women professionals. I describe it as uneventful. Sometimes, it's just, you like the numbers, numeric aspects of work, and not necessarily, let's say, the networking and the outgoing kind of things. That's a really good job.
Okay. Yeah. So, and that word came up that really caught my attention when you said it at first. You said it wasn't eventful enough, and now you've transitioned into being a social entrepreneur. So, what was the impetus for that? Because that's got to be like highly qualitative.
Yeah, very. So I'll go back a little bit too into before my making the decision. So after I don't know, 15, 20 years of investment management related kind of positions, especially at Schwab, I thought about creating investment products a lot. In my role as 7 years at Schwab Investment Management, I think I launched, or me and my team launched four different new mutual funds, and as maybe some other strategies, non-mutual fund strategies, and reposition different ones. So that was on my mind all the time.
Mhm.
At the same time, for the past 15 plus years, I focused my nonprofit volunteer work in fundraising.
Oh.
So I was, of course, being board members, I led a capital campaign for my church. And at the same time, in 21, 22, I took a year off, and I was a volunteer full-time development director. It's like a mouthful, but there was maybe the first time I was inside a nonprofit as taking on a staff role. And that's kind of where I kind of felt, okay, a lot of people want to support this nonprofit, but the financial ecosystem to get the money there is kind of clunky. But I didn't have a solution until 2015. And that in 2015, I got the idea of what became Lendonate. So my investment and my philanthropic mind kind of literally merged into a concept that's a little bit more seamless for the investor donor.
Wow, that's like it's like the perfect merging for you, as you were saying, because you were doing philanthropic work. I'm curious, do you find that a lot of nonprofits, I'm going to say it this way, they don't really operate like businesses? Like they don't, like they don't operate that way. They don't think that way. Maybe they don't have anybody on staff that way necessarily, especially if they're a little bit smaller. I wonder, first of all, like you coming in with that, you probably saw that and just, yeah, could you speak to that a little bit?
Of course. So I'm gonna let me answer that question first. So whether they operate like a nonprofits operate like a business, it depends. And sometimes when the answer is no, perhaps the answer is they shouldn't. And I'll come back to why maybe they shouldn't. But to think of the nonprofit, we all know nonprofits from the perspective of being asked for donations. I'm sure almost like without exceptions, all of us have been asked. So what do we hear? We hear the message they want us to hear, which is that there's a great need that they're serving, and the more money that goes to them, the more that they can serve. And if they're asking for a donation, they're going to present a more vulnerable picture of them, right? Because if like, hey, we have $1 billion sitting around and donate to us, that's not going to work. So that's why I think we all kind of skew towards a bias that we think nonprofits are weak. And some are. There are over 1 million nonprofits in the US. The nonprofits we tend to work with are the larger, a third, if not a fourth. Many smaller nonprofits, they're set out to serve a very specific need in their area. So they're not really even trying to run like a business. They know exactly which community they're serving, and they're not looking to grow. Like, this is exactly what we want to do. We have a 1-person staff and 10 volunteers, and we're good. That's what I meant. Like, sometimes not every nonprofit needs to, like, okay, what's our exit strategy, or what's our exponential growth. On the other hand, there are a lot of nonprofits, especially those that selectively decide to reach out to lend donate because they have the next big plan, because they have major projects and they're looking for financing. So unbeknownst to a lot of people, nonprofit financing is actually huge business. Think of the US consumer credit card debts. I think it's, by now, I haven't updated my information for the last 2 years. I'm going to guess is between 800 billion to a trillion in terms of size. The nonprofit debt size is about 80% of the US consumer credit card debt size. Wow. So most people are like, what? they borrow? They do. They actually, a lot of it goes to real estate financing. So I'll stop there, and then let's see, and we'll take it in pieces.
Yeah. Wow. What do you know? It goes to real estate financing. I mean, some of that makes sense. And also, I guess, understanding that really all money is debt, and everything is debt, really. And that debt makes the world go round. I guess that would make sense. And you're right that the impression, the perception of nonprofits is one of vulnerability and weakness. And I think it's really important to state that and to see it, and that they're not weak. I just wonder, maybe in some of their positioning, but that public perception is really strong, and it's really about helping others. And it's admirable that nonprofits do want to keep their costs down, of course, because that money needs to go to people who need it. So yeah, I wouldn't have imagined that the debt was that high. But if I really think about it, then it makes sense. I can't imagine that they are raising donation money, rather that they're getting donations for CapEx. That wouldn't make sense to me, right? I mean, is that a line item issue?
They just use different terminology. So, for example, we recently completed a loan. You might have seen this because you invest for a Bay Area nonprofit that supports affordable housing and is a land trust. We'll leave that to the side. But here's the situation, beautiful story, where another nonprofit founder, she passed away, and just beforehand, she had already planned to donate her residence to this housing nonprofit. Say, you can have my home. There are some conditions. One was there was someone living there previously who was unhoused, homeless, and she had let this person stay there, and so no longer unhoused. Beautiful story already. And she said, if you take over, we would love, you would need to let this person stay. Additionally, because she also founded a nonprofit that is more like a soup kitchen, also serving in poverty alleviation, we would like for you to use this house for that benefit. So that now she's created a joint collaboration between two nonprofits after she has passed, providing a house to do all that beautiful work. And why was Lend Donate involved? Because the house is already donated, because there was a small mortgage that was still remaining on the house. So in order to take over, they need to either pay it off or just kind of assume that debt. So we took that debt over, and then they expect to pay it off, once they fundraise for it and prepay the loan when it's done. So there are a few touch points of philanthropy, a few touch points of investment, and then they really merge into a single, very impactful story.
So can I ask a clarification question?
Please.
So outside of the example you gave, where I understand the usage of debt, like, where are all of these other nonprofits? Why are they borrowing so much capital, and what is it being used for?
Yeah, in terms of what they're using it for, the $600 billion that I described of this size, 75% of that is used to finance real estate. So think of the schools, the hospitals, the churches, performance center. affordable housing, I can go on and on. These are very real estate heavy type of nonprofits. Then where do they get their financing? Of that debt, there's close to 500 billion of that debt is used for real estate financing. Approximately half of that are held by, a little or more than half are held by banks that lend to them. And the other portion were structured as tax exempt bonds that are on the market. So they qualify for raising money in a tax exempt bond, just like municipalities. So that's why it's so top heavy into real estate focus. Now, coming back to Lendonate, the largest loan we have done was to help facilitate a $37 million real estate construction, again, for a local Berkeley beloved nonprofit Berkeley Repertory Theater. But if I were to describe like the need, Daniel, your question, besides real estate, the general need is to resolve a chicken and the egg problem for nonprofits. In a regular for-profit small business, let's say I perform a service, you pay me. In nonprofit, they get earned income just like that. So that tends to be immediate unless your contract is with the government. So a lot of times government grants, or it's not truly a grant, it's, they have to earn their service, comes in arrears. So a prime example of affordable housing project we're working with in Southern California, they won an RFP from the city to develop affordable housing. Now, in the past, when capital was available, they get the money and they start construction and do all that. In the past couple of years, that pot of bond financing from the cities or municipalities are no longer available. So now they need to go find the money so they can build it, in the end, get paid back. So this chicken and the egg problem is new to some, not new to others that have always been working within the government grant. It's not limited. I didn't mean to just paint a negative picture of government. They definitely are very key stakeholders to nonprofits and really good partnership. But just the way that things work is that you perform the service, we'll bill you in arrears.
Hence the need for capital.
Hence the need for original. Sorry. Thank you for the
No.
punchline.
I mean, you said it. It just that's so interesting about the bonds. I discover all kinds of new investment products every day.
And it's really neat, right? If you think about, to investors, the term bond or investment notes is the investment term. Behind it are basically loans that are, secures these notes. Who do you want to lend to? What type of entities or people do you want to lend to? Of course, those that have a high propensity to repay. Yeah. At Lendonate, we expect in the long run, as we gather more information, that we will prove, my hypothesis, that the nonprofits are the best borrowers there are when compared to individuals, small businesses, corporates, and whoever else. Why? Because the propensity to repay hinges on two things: the ability to repay and the willingness to repay, right? So if we do our job right, underwrite the nonprofit as if we would underwrite anybody else, except we do have a specialty in underwriting nonprofits, analyzing their financial picture. If all things being equal, we believe that the nonprofit leaders, because of the conscientious leaders that they are, the willingness to repay would be the highest of all the categories. Think of 2008 when global financial crisis, people who are over leveraged in buying homes and investment homes. And then it's like, in the end, it's like, oh, wow, I'm underwater. What do? I'm just going to walk away from my debt, right? So that's fine. You can take my home. Not to say nonprofit leaders won't do it, but we've talked to so many of them. They ask the questions that are proactive. Oh, I'm reading your loan agreement. I see this clause. I just want to know if we do this, whether we would violate it. They actually really are very deliberate people, very cautious and prudent leaders, that they want to make sure that they do the right thing. So we love partnering with them as there are borrowers to offer the investment notes that we can to investors.
That's phenomenal. So let's tell people what Lendonate is specifically, because I'm pretty sure at this point everyone is like wanting, if they're not already on the website, but just to hear it from you. And I will preface this by saying that, as you know, from Julie Castro Abrams, I learned this about Maimonides, the Jewish philosopher, who says that investment is the highest form of charity. And I feel like Lendonate embodies that in the most beautiful way. So I'll preface Lendinate that way. And if you could tell us a lot more about it.
Thank you. I will try to do better than our 2-minute video on our website, but if I don't, go ahead and watch the 2-minute video. It'll explain everything. But basically, our philosophy is that a lot of investors, social-minded investors, really don't want single-purpose tools. They want to be holistic and integrate everything that they do in a very easy sort of fashion, not a binary decision as in, yes, I'll do this, no, I won't, or I do it now, or I do it later. So this is what we've built. Our process starts with the nonprofits applying for a loan. We ask all the questions just like a bank would about them, and we have play 20 questions and back and forth exchanging information. In that process of due diligence, our underwriting, we then assess if they qualify, what rate they qualify for. The rate is what we call our ceiling rate, which is also what we believe is the fair market rate. Some loans may, because they're so strong, they're maybe closer to 4 or 5%. Some loans are a little bit, more uncertainty. They're maybe closer to 8 or 9% interest, for example. We present each case on our website with their stories and financial background and the use of funds and all that, the whole picture. And let's say you look at an investment and say, hey, I actually like that. It's a school or it's whatever. And the fair market rate, I'll pick a number, let's say is 6% interest. And you say, great, like you said, I'm using my retirement funds. I really need to, get my 6% interest. So I treat this as my fair market investment. So I'm taking, let's say I'm investing $10,000 and I want 6%. And let's say Daniel says, not only do I love their cause, actually my kids go to the school or something, and I'll just take 4. Every investor gets a chance to offer not only the dollar amount, but also the interest rate you charge, anywhere between 0 to that market rate. You can also add on a donation already upfront. And our system, the technology, is already built to prioritize more generous offers ahead of market rate offers if the loan is oversubscribed. That way, in the end, we package, let's say the loan need is $100,000. We packaged all the best offers to fill that $100,000 bucket. Instead of receiving a 6% interest loan, the nonprofit now receives the weighted average interest rates, let's say 4.9 at this point, and then maybe a couple $1,000s of donations while we sourced it. And then every month as they repay, we take that interest repayment, or not just interest, repayment, and reallocate it back to each of the investors based on their own specific rate. So whether you're using this as a social impact investment, every time I invest, I just want 2%, or a fair market rate investment, and you can tier your own offer too. It really is a way to customize your investment as well as your donation, because you can choose to click on a button. Once it's all done, you're looking at your dashboard, you have 10 loans on your dashboard, and you say, I need more deductions this year. So you can choose like loans 1, 3, and 5 and say, you know what, I want to forgive $500 each to them, and we take care of all of that on our platform.
Oh, wow. I didn't realize that about the loan forgiveness at the end. Yeah. So now I understand your background and this. Now that all comes, that really all makes sense, because it's in the back, it's complex.
Yeah.
In a way, what you're doing, it's not really straightforward. And I mean, I invested in, the most recent one was the India home, the India seniors home. And I wish I had more funds in my IRA. I mean, I'm sure for a lot of people listening are investors, and we put more of the interest bearing investments in IRAs versus outside of them. But I tell everybody that I know about Lendinate, because it is about helping other people and doing it in a way that feels good. And so I do like that mechanism of the being able to like bid and give a different rate, or like take a different rate. And the other thing I really like is that you can ask questions and get answers from the nonprofit. And I find that really good. And so you type it up, and so everybody can see the questions in case people do. But to be honest, I've rarely seen questions. I asked one once because I was going through the financials, my very first investment. I really wanted to understand. I had all these questions, but I think usually people they trust that you've done the underwriting. And I also think that when it comes to this form of investing in charity, I suppose is, and I may be making an inference, but that people are happy to do it without drilling and like grilling them about everything the way we do in business, or the way we do when we do our real estate investing at Alpha.
You would be surprised how some of the nonprofit leaders love to answer questions. Actually, most of them really do love to answer questions. We've had one where usually, like, you write them a question, even in email, within hours they come back with like a prose of, wow, like they really thought this through. And then sometimes you ask about, well, what about plan B, right? If you didn't get that kind of revenue, what would you do? Well, not only did they think about plan B, they thought about plan C and D. So I must say personally, I'm always very impressed by the thoughtfulness of these leaders. Sometimes they don't get to share that side of them because they know they only have limited connection with potential donors when we're wearing our donor hat. So they don't always focus on, well, here's our plan B. But because we're talking about loans, things that need to be repaid, so we do ask them a lot of those type of questions and really can tell whether they have been thoughtful and planning.
So I'm so curious, what percentage of people select an interest rate that's below market?
Great question. It depends on a few things. The cause. So we found that the loan that I think still is true to date, the loan that received the most below market, I think they dropped 3 whole percentages, like from a ceiling rate of 7 point something, and they got just under 5, was a cause that serves the unhoused population, the homeless community, by providing mobile showers to the encampments, right? So it's a cause that almost like we don't even need to say a thing. Everybody understands the cause. There are other ones that tend to receive closer to market rate or maybe at market rate because their causes are more nuanced and less broad-based. I don't want to say less compelling, just less broad-based, where people feel like, actually the 6% does sound good. And then it's an easy decision, just 6% that. But a percentage, I don't think we've done weighted, I don't have the stats, but I would say majority of them hover close to market rates, especially when the loan is large. So the largest loan we've sourced without like outside institutional partners, just really on our platform, was about $1 million. And when we're talking about funds that size, people are truly investing because it's an investment.
And I'm glad you brought up institutional investors. I was curious who investors are outside of individuals, and is it only accredited investors? I don't remember.
Yeah, it is. Right now, we're only operating under 506C, which is accredited investors. So while we set the investment minimum really just to $100, but accredited investors tend not to, spend their time on $100 investment. So our typical investments are larger than that. But yes, accredited investors only. As far as individuals, especially high net worth individuals, their wealth is more layered and complex. So we have individuals, even though they themselves are making the decision or jointly with their wealth advisor, they can direct their funds from regular investments, from their donor advised funds, private foundation, retirement funds, as you said. When we go to institutional partners, those are usually in the multi-million dollars, and we partner really well with community development financial institutions that specify in specifically invest in nonprofit lending, as well as banks. Banks are very structured in what types of loan and how they can lend it out. So while all bankers really want to support nonprofits, sometimes the structure is so rigid that while they want to give the loan, they cannot, for various reasons. So we partner really well with them, either because they send them to us and we do the loan, or we resolve a problem for them so that we can co-lend. We partner with a bank, for example, where they were senior in position and we were junior in position. So as a junior lender, we can establish the ceiling rate to be higher than the banks, right? Because we're higher risk. And some investors really love that, don't give me the when interest rate environment was lower, like I don't want to see more of the 3 to 4%. I know they're strong, but can you get me something higher? So sometimes by taking a junior position, we can offer that to the right type of investors.
Oh, that's really interesting. And I imagine that banks and institutions and, sophisticated investors too would understand that it's an asset-backed loan. So it
Yes.
has the collateral.
Right. We're working on one where the senior is a CDFI and is for a school in Southern California. And we'll be, oh, actually, I think we just put it on our website. It's a private school and they prefer to keep a little bit more of their cash than the senior lender wants them to, to commit. So we're now junior behind a senior lender and it all works out for everyone. And they expect to raise enough funds to pay off everything, both of us in 3 years, which is why the terms are 3-year loan for a real estate purchase.
Oh, that's fantastic. I want to ask a timely question, I guess, and it is around interest rates because we are going into a rising rate environment. Is that going to hurt nonprofits?
Well, it hurts everyone,
Yeah.
or if you're investing, so that's good news.
Yeah.
So for investors, good news, right? Because you'll be seeing more and more of the rate of return without the same level of risk that you saw that you needed to take a couple of years ago to get the same type of return. For borrowers, individuals or not, I mean, nonprofits or not, including individuals, that may create a problem. We'll see. Just like the Fed would say, let's see how this goes and whether rates go up again. So far, after the pandemic, I think that time really allows some of the more well-positioned nonprofits to create a strategic plan. So we're seeing actually even more so than before the pandemic, applications for financing real estate. They recognize that this is the time to lock in some rates, get their dream to come true, to move into permanent property, for example, or in other cases where their program, like affordable housing, is about real estate. They have a strategy to buy a bulk of real estate. For example, we're talking to 2, if not 3 nonprofits of the same type, even though they serve in different causes. They want to buy residential houses in quantities because in one nonprofit serves adults with disabilities with these homes that are designed or retrofitted for that use. The other are for at-risk youth that have aged out of the foster care, so ages 18 to 21 before they really turn into adult, rather than just dumping them out of the foster homes. This is a transitional residence for them, and so both are really impactful causes. They need acquisition capital so that they can be competitive in the housing marketplace to buy these homes and then have time to line up whether it's grants and financing.
So can I ask a question real
Yeah.
quick, Adapia? So the examples you give about like the market rates, the numbers you're using, makes me assume that investors, lenders view nonprofit borrowers as riskier than individuals. Is that the case?
I think, of course, there's always that assumption that may be there. When we look at the financials, we really try to be very objective because one can look at the need for donations as a weakness. But let me ask the other side of that coin. If we're a for-profit company, Lendon is a for-profit company. If all of a sudden you say, "Hey, would you like to receive some donations? Like free money?" Like, of course. Why would I not, right? So it can be looked at actually as a benefit. They just really need to make sure that their budgeting is sound and current. So, for example, each of the sub-industries should be looking at the benchmark. If they're serving, let's say if there's a school, and there is actually a pretty standard ratio of earned income versus donated income. If they stray too far from their benchmark, something might be off. Either because they're leaving money on the table, they should be fundraising more because other schools get more donations. Or they may be, the other way, like, are you charging too little? So there is actually benchmark to each of these industries. And if they're serving the low income or no income population, we would not and should not see any significant earned income because they can't pay. So it is 100% grant model, and we have to recognize for it. Some nonprofits hire very top-notch development directors, and grant writers, so that if we can see, let's say year after year, they're able to get 100% grant and it's increasing. How is that weaker than any for-profit company? So we take that lens and evaluate them based on each of their benchmarks.
Gotcha. Yeah, it's challenging though, right? Because I think my gut reaction is I'm more comfortable depending on revenue, particularly recurring revenue of a for-profit company than I am like the potential for future donations, right? It just seems like there's a lot more volatility around like, will people continue to donate? If there's 8% inflation, over this next year, what will happen? What will happen to the revenue of these nonprofits? So I think that all makes sense to me. It's something, admittedly, I've never actually thought about, but it's a really interesting project you're working on.
That's why we're doing what we're doing. It is true that we're usually investors like to be compensated for uncertainty. So therefore, it is more challenging when the underwriting model is the typical bank underwriting model, and banks have their underwriting model designed to evaluate for-profit companies, corporations, or and lending to nonprofits is an outgrowth of that model. Like, well, why don't we just take that and apply to them, because they have a balance sheet, they have an income statement. But in reality, why we are critical to in this space is because we understand better as to that donated capital. Some may think it may be volatile, but if we're able to see, like, oh no, they received this type of grant and has been consistent for them, and in this space, we know that, let's say, that type of grant is consistent, then to us it's less of an uncertainty. I used to do quantitative equity investments, like at Schwab and American Century, where to trade portfolios, I did portfolio optimizations, like all these things. People oftentimes refer to us as black boxes, like, oh, that quant investment is black box. And to which I respond like, well, it's black box to you. But we design every element inside that box. We understand how it works. It's like we're the engineer of the car as opposed to the car salesman. And so we know how to tweak the model to make certain adjustments. So here, using a similar analogy, investors or bankers are less familiar with what makes nonprofits tick. They may see that, oh, risky because, who knows whether the grant will come. Well, there are ways to assess that for a higher certainty than maybe the average investor. So we love analyzing, asking them a million questions, and translating that into more understandable terms on our platform for investors to consume. And as Pia said, you can ask your questions at the time. They love answering questions.
Yeah, and all the financials are there and the story is there and they have their videos. And so you can do like the way we present a deal with our underwriting. It's very similar. And Vivienne, I was going to say, you called it the black box, and I'm thinking the big brain. I'm thinking you guys are called the big brain. Vivienne's got the big brain in the room.
It really is our whole team. I obviously, okay, I am the founder, but we really bring people on that we think really are good fits to build out this team of knowledge. So I have been, portfolio manager, our COO, Lynette Pang, and Adapia, you've emailed her before.
Awesome.
She also was a mutual fund portfolio manager before, and for 20 years at American Century. And then our credit strategist and the prior chief credit officer both have had roles within banks and credit unions as chief credit officer or regional credit approving executives. So we do very much start out with the lens of what does the industry think of this loan? And then when we don't have the expertise in-house, we go outside and we pull in the expertise like investment bankers.
Yeah, thank you for that. I've so enjoyed this conversation. I can't wait for everyone to hear this. You're going to be hearing this while you hear me say this because it'll be published. But there's one last question that we ask all of our guests, and that is, what does wealth mean to you?
That's a great question. Wealth to me, if we start with, I'm thinking of concentric circles, like at the core of it, of course, wealth means money, what I have, and then, I'm moving out, right? What I have, but then what I do with it is also wealth, how I leverage my money to influence other capital and help guide it to causes that I care about. Sometimes it is socially impactful, causes, and maybe some other times it's others. So it's a combination of money, influence, and then my network, because, with me having met you and other people like you, the wealth is money and the people around and the network around me. That makes a very holistic picture of I bring my whole person and I bring my whole network to try to steer money and wealth and attention to the areas that are needed. So I don't know if that's too vague, but I do think very broadly when it comes to wealth. Now, I used to think very narrowly. Wealth is, like the money you have, and I wanted to get a rate of return. But I think now in a new world, and especially with what I've been focusing on and talking to so many different types of stakeholders in this ecosystem, that definition should be broadened.
Oh, I love your definition. I don't think it was vague at all. And the idea of the concentric circles. And there is that saying that your net worth is your network as well.
Yeah.
So that said another way. Well, Vivienne, thank you so much for joining us today, for sharing about Lendinate and your experience and all your expertise. I really appreciate it and appreciate you and everything that you're doing over there at Lendinate.
Thank you for having me. I love this conversation, exploring all the different ways to support nonprofits.
Absolutely. And informing and educating people about them. I mean, I don't think anyone, unless you're in the industry, really understands. We have this perception. Maybe just the last thing I'll say, maybe nonprofits have a PR problem.
Yeah, sometimes they do, and for many reasons. Of course, resource limitation is one, but yeah, no, they do. Actually, you reminded me of one key point, if I may throw this in.
Yeah, let's do it.
You
Yeah.
were probably thought of the question but didn't ask it, is, well, what do investors get in terms of rate of return on our platform?
Oh, yeah.
Because everybody gets to choose their own rate, so we haven't really published any, statistics from a ROI perspective. But recently I did look at my own portfolio, and I have committed, and I have done, to invest in every single loan investable on our marketplace. So personally, I invest in every single loan. So I looked at two things. Well, actually, one thing, but they're related. My own. Oh, before I say this, disclaimer, of course, this full disclosure, past performance is not indicative of future results, but I looked at my own portfolio and I have chosen to take a more philanthropic rate sometimes, more market rate other times. Since inception, my annualized return, if you will, was a little bit over 5% interest. So kind of like thinking of investing in private debt notes, about a 5% interest for me. And then this is across the board, we have had no defaults, no loan workouts needed so far, knock wood. So we are very intentional in choosing the right nonprofit partners, and we do decline those and send them maybe to other sources like grant opportunities if we don't feel that they should be taking on debt right now.
Oh, amazing. I'm glad that we added that last point to the conversation. So now I will let you go for real. Thank you again, Vivienne, so much.
Thanks again for having me. Thanks, Daniel and other Pia.